Build your dreams, live rich, and leave rich.
Welcome to Live Rich and Leave Rich. You know, when we hear the phrase live rich, our minds often jump to fancy cars, big houses, and lavish spending. But I believe living rich is something much deeper and honestly much simpler. It's about financial peace. It's about living a life that is completely free from money-related stress. And today, we're going to take a huge step towards achieving that peace by pulling back the curtain on a powerful investment tool that many people find, well, a little intimidating.
All right, before we dive in, let's get the important stuff out of the way. Please remember, this explainer is for your education and awareness only. Investing in the stock market always involves risk. So before you make any decisions with your hard-earned money, it is absolutely essential that you speak with a SEBI-registered financial advisor who can guide you properly. Okay, let's get right into it. When you hear the words Dalal Street or the stock market, what's the first image that pops into your head? For most of us, it's a scene from a movie, right? An expert in a sharp suit, maybe shouting into a phone, completely surrounded by 6 glowing computer screens flashing with charts and numbers. It feels like this very complicated, high-stakes game, a private club that regular people like you and me aren't invited to.
Well, I am here today to tell you that that image, that feeling of being an outsider, is one of the biggest myths in the world of finance. The idea that you need to be a full-time, screen-watching expert to invest your money smartly is just not true. And today, we are going to break that myth for good.
So here is my promise to you. Give me the next 25 minutes of your time, and I will show you exactly how to invest in a basket of India's top 50 companies, or even own pure digital gold with the same ease and speed as walking into your local Kirana store and buying a packet of biscuits. Yes, it can be that simple, and it can be that instant.
Now, to understand this powerful investment tool, we don't need any complex charts or spreadsheets. We just need a simple story that all of us can relate to. So let's go to the market and talk about buying fruits.
Imagine you want to buy a basket of different fruits. Option 1 is a mutual fund. This is like calling the fruit seller in the morning and placing a custom order. You say, I want some apples, some oranges, and a few bananas. But here's the catch. You don't know the final price right then. The fruit seller has to go to the market, buy everything, and only in the evening, after the market is closed, will he call you and tell you the total cost. In finance, we call this the end-of-day net asset value, or NAV. But now let's look at option 2, an ETF. An ETF is like a ready-made fruit basket that's sitting right there in the shop window. You can see it, and more importantly, you can see the price tag on it. You can literally watch the price change during the day. If you like the price at 11 a.m., you can buy it instantly, right then and there. If you think you'll get a better deal at 2 p.m., you can wait and buy it then. You see the price, you like the price, you buy it. It's direct, it's transparent, and it's instant.
So that's the big idea, a ready-made basket that you can buy instantly. Simple, right? But now, let's leave the fruit shop and head to the stock market so we can understand how this basket is actually built and how you can use it. We're going to break it all down into 4 very simple micro lessons.
The very first thing to get your head around is that an ETF is a true hybrid creation. Think of it like this. It has the soul of a mutual fund, but it has the body of a stock. Now, what does that mean? Like a mutual fund, it's a basket that holds many different things. So when you buy just one unit of, say, a Nifty 50 ETF, you are not buying a single company. You are instantly buying a small piece of all 50 of India's largest, most successful companies. This gives you incredible diversification, which, as you know, is the #1 safety feature of a mutual fund. But here's the magic. Unlike a traditional mutual fund, this entire basket is listed on the stock exchange, just like a single share of Tata Motors or HDFC Bank. And because it's listed like a stock, you can buy and sell it anytime the market is open, from 9:15 in the morning to 3:30 in the afternoon. It really is the best of both worlds.
Now, this hybrid nature leads to a very important practical difference in how you own it. Because an ETF trades like a stock on an exchange, there's one absolute non-negotiable requirement. You must have a DMAT and trading account. Think of a DMAT account as your digital locker. It's a safe place where all your shares and ETF units are held in electronic form. With the traditional mutual fund, having a DMAT account is often optional. You can just get a statement of account from the fund house. But for an ETF, since all the buying and selling happens live on the stock exchange, the transaction has to settle through a DMAT account, just as if you were buying a single share of Reliance. This is a critical point. So the very first step on your journey to investing in ETFs is opening that DMAT account.
We talked about this a little in our fruit basket story, but I really want you to understand why this live pricing gives you, the investor, a massive advantage. It all comes down to two things: control and the ability to seize an opportunity when it appears.
Let me paint you a picture. Let's imagine a typical day on Dalal Street. The market opens at 9:15 a.m., and everything is going along smoothly. But then, at 1 o'clock in the afternoon, some unexpected bad news hits the headlines, and the market suddenly tumbles, dropping 3% in a matter of minutes. Panic starts to set in. Now, an ETF investor sees this happening live on their screen. They think, wow, the entire market is suddenly on a 3% discount. This is a fantastic opportunity to invest for the long term. At 1:10 p.m., just 10 minutes after the fall, they place their buy order and instantly buy the ETF at that new, lower price. They have successfully taken advantage of the dip. At the exact same time, a mutual fund investor sees the same news and also decides to invest. But when they place their buy order at 1:10 p.m., it doesn't execute. It just sits in a queue. Their transaction won't happen live. They are forced to wait until after the market closes at 3:30 p.m., when the fund house finally calculates the NAV for the day. By then, the market might have recovered a little. They have completely lost the chance to act on that specific midday opportunity. The ETF gives you the power to act on information in real time.
Okay, this ability to trade live is fantastic. But it does come with a small hidden cost that every single beginner absolutely must understand. It's not a fee that the fund company charges you. It's a natural cost of trading on an exchange, and it's called the bid-ask spread. Sounds complicated, but I promise you, it's not.
Let's use our shopkeeper's margin analogy to make this super simple. Just look at the table on your screen. At any given second in the market, there are two prices for an ETF. The ask price is what the sellers are asking for. In our example, it's 100 rupees and 5 paise. The bid price is what the buyers are bidding or willing to pay. In this case, it's exactly 100 rupees. That tiny 5 paise difference is the spread. Now here's the key. When you go to buy, you have to pay the higher ask price of 100 rupees and 5 paises. And when you decide to sell, you will receive the lower bid price of 100 rupees and 00 rupees. That little spread is the small, almost invisible cost of your transaction.
So the obvious question is, how do we keep this cost as low as humanly possible? The answer is one powerful word: liquidity. Liquidity is just a fancy word that means there are a lot of people buying and selling that particular ETF all day long. When the trading volume is high, there's a ton of competition between all the buyers and all the sellers. And this competition forces that bid-ask spread to become very, very small, sometimes just a single paisa. But if an ETF has low volume, what we call illiquid, that spread can be quite wide and you could lose more money just entering and exiting your investment. So here is the golden rule for any beginner investor. Always choose ETFs that have high trading volumes. A perfect Indian example is Nifty Bees, which is famous among investors for its huge liquidity. And a word of warning. Many other ETFs in India unfortunately suffer from very low liquidity, which can make them much more expensive to trade than they first appear.
So, now you know how ETFs work, you know their advantages, and you know what to watch out for. But what can you actually invest in? Well, just like there are many flavors of ice cream, there are many different flavors of ETFs. Let's look at two of the most popular and easy-to-understand options available for all of us here in India.
On the left, we have Nifty Bees. This is one of the oldest and most trusted ETFs in India. When you buy just one unit of Nifty Bees, you are instantly buying a tiny fraction of India's top 50 largest and most powerful companies. It is literally like owning the entire market in a single click. You aren't betting on one or two companies to do well. You are making a simple, powerful bet on the long-term growth of the entire Indian economy. It's brilliant. Then, on the right, we have Gold Bees. For generations, we Indians have invested in physical gold, but it comes with headaches, doesn't it? You have storage costs, bank locker fees, security concerns, and of course those making charges when you buy jewelry. Gold Bees is the modern, smart solution. It's digital gold. Each unit's price moves exactly with the market price of real gold because the fund actually holds real 99.5% pure physical gold bars in secure vaults on your behalf. It is the easiest, safest, and most cost-effective way to own gold today.
All right, we've covered a lot of ground today, and with that, a few new words. The world of finance absolutely loves its jargon, but we're here to cut through all that noise and make it simple. So let's do a quick rapid-fire round to make sure these key terms are crystal clear in your mind.
First up, demat account. It is simply a digital locker where you safely keep your shares and ETF units.
Next, bid-ask spread. That's just the small difference between the immediate selling price and the buying price of an ETF.
And liquidity. This simply tells you how easily and quickly you can buy or sell an ETF without changing its price.
And finally, market price versus NAV. An ETF's market price changes live all day long. A mutual fund's NAV is calculated only once, after the market closes.
And that really brings us to our final thought for the day. We've seen that an ETF can give you the wonderful diversification and safety that comes with a mutual fund, but it combines that with the speed, the transparency, and the real-time control of owning a stock. It is a truly powerful hybrid tool for the modern investor. So the question I leave you with is this. If you want the safety of a mutual fund, but the speed and control of a stock, what are you waiting for?
I truly hope this has brought some clarity to the world of ETFs for you. To help you continue on your journey of financial organization, I've created a special tool called the Legacy Diary, and you can find the link for it right in the description below. If you found this explanation helpful, please subscribe, and more importantly, share it with a friend or family member. Financial knowledge is a gift that only grows when it is shared. Thank you for your time. Live rich and leave rich.